China's consumer prices continued their downward trend for the fourth consecutive month in January, alongside a drop in producer prices, highlighting the significant economic hurdles facing the world's second-largest economy as it strives to rebound from the aftermath of the COVID-19 pandemic and associated restrictions. Today, we are going to talk about how China's falling consumer prices threaten the global economy. The Consumer Price Index, CPI, recorded a 0.8% decline in January, surpassing the 0.5% prediction from a Reuters poll. This decrease, as reported by the National Bureau of Statistics, NBS, marks China's most substantial drop since 2009 and raises concerns of prolonged deflation through the first half of the year, according to Bloomberg analysts. Trade relations between China and the United States, two pivotal global players, have shown instability. In 2023, China's total exports decreased by 4.6% to $3.38 trillion, with exports to the U.S. experiencing a notable 13% decline from the previous year. The overall decrease in China's exports to the U.S. amounted to 16.4% in the first 3 quarters of 2023, with imports also dropping by 6%. China's foreign trade has been significantly impacted by the global decline in demand, with recovery efforts stalling following the lifting of COVID-19 restrictions. Additionally, the demand for Chinese goods has been dampened by the tightening of monetary policies in various countries aimed at addressing persistent inflationary pressures. Despite its historical reputation as one of the world's fastest-growing economies, China has experienced a notable slowdown in the past year. While GDP grew by 5.2% in 2023, slightly surpassing the third-quarter forecast of 4.9%, it fell short of the 5.3% expectation from a Reuters poll. However, looking ahead, the International Monetary Fund, IMF, remains optimistic about China's economic role, projecting it to be the leading contributor to global growth over the next 5 years, with a contribution representing 22.6% of total world growth, twice that of the U.S. Furthermore, the IMF anticipates China's contribution to global growth to reach approximately 34.9% in the current year. Economists have highlighted various challenges confronting China, including a rise in youth unemployment, falling consumer prices, a deepening real estate crisis, and concerns among foreign investors. Julian Evans Pritchard from Capital Economics, speaking to the Associated Press, expressed expectations of further declines in exports. He emphasized that foreign demand might experience a more significant drop than what has been reflected in current customs data, predicting a bottoming out around the middle of 2024. Richard Hornick, an adjunct senior fellow at the East-West Center, pointed out that China's economic slowdown predates the COVID-19 pandemic. He noted a significant decline in property prices, which holds particular significance for President Xi Jinping and the Chinese leadership. Real estate, Hornick explained, has been crucial in distributing wealth among citizens, with property ownership often serving as their primary financial asset. Hornick mentioned the 2008 financial crisis as a turning point in China's economic strategy, shifting focus from exports to domestic consumption and increasing investment in real estate and infrastructure. Martin Adamer, an economic analyst, attributed the decline in inflation and the shift to deflation in the latter half of 2023 primarily to weak demand. T.S. Lombard, an independent economic researcher, forecasted continued challenges for China's economy throughout 2024, citing a loss of confidence as a significant factor hindering its revival. However, the Consumer Price Index, CPI, rose by only 0.2% throughout the year, falling short of the official target of approximately 3% for the 12th consecutive year. According to Carlos Casanova, senior Asia economist at Union Bancaire Privé in Hong Kong, the persistent deflation or disinflationary trend is indicative of weak domestic consumption. He attributes this decline partly to a significant stock market downturn, which has negatively impacted consumer sentiment and spending. Factory gate prices, reflected in the Producer Price Index, PPI, continued to experience deflation, with a 2.5% decrease from the previous year in January. This was a slight improvement from the 2.7% decline seen in the prior month. However, ongoing factory deflation poses a threat to the survival of smaller Chinese exporters who are engaged in fierce price competition amid shrinking business opportunities. Casanova emphasized the need for stronger policy support from the People's Bank of China, advocating for broader interest rate cuts in February. However, he noted challenges such as limited policy space and issues in policy transmission, which may hinder the implementation of such measures. Economists from the UK-based research firm Capital Economics attributed the decline in January's CPI to the typical price fluctuations observed during the Lunar New Year holiday, a time typically marked by heightened consumer spending. Julian Evans Pritchard, the firm's head of China economics, expressed anticipation of a reversal in food price deflation, which he believes will push consumer price inflation back into positive territory in the upcoming months. The weakness in China's consumer price index prompted expectations among economists for interest rate cuts to stimulate demand. However, China's central bank opted instead to lower the reserve ratio for commercial banks by 0.5% to inject liquidity into the economy. Factory gate prices, as indicated by the Producer Price Index, continued to decline in January, albeit at a slower rate compared to December. This decline reflects softer energy prices and subdued domestic demand. Despite these challenges, there has been a slight uptick in manufacturing activity, with the Purchasing Managers' Index inching higher to 49.2 in January, from 49.0 in December. Attention now turns to the government's upcoming National People's Congress, where new policies aimed at supporting economic growth are expected to be unveiled. Many economists anticipate that the official economic growth target for 2024 will remain around 5%, consistent with the previous year's target. China's GDP growth stood at 5.2% in 2023. Lin Song, the chief economist for Greater China at ING, recently downgraded the bank's growth forecast for China in 2024 to 4.8% from 5%. This adjustment reflects expectations of moderate policy support, coupled with challenges stemming from a property market downturn and pessimistic sentiment. In response to the latest data, Song noted that while the figures fell short of expectations, they do not necessarily indicate that China is at risk of deflation. Highlighting other data points, including a month-to-month increase of 0.3% in the CPI, Song suggested that China is not entrenched in a deflationary trend, akin to other economies experiencing higher inflation levels. That's all about today's video. If you like this video, don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos. Let us know your opinion in the comment section below.